Happy Monday, everyone. Hopefully you had a great Thanksgiving weekend filled with great food, good family time, some good football, and lots of rest. First, let me apologize for the gaps since my last market update. I've been busy recording some great content for you all, stuff that I hope you not only enjoy, but find really helpful. Now, I am excited that to announce moving forward, I will be doing a market update every single Monday to kick off the week. And if there is any major news in the market, I'll add one or two updates throughout the week just to kind of keep you in the loop. So let's get back to it. First thing, before we dive into this week's jobs data, let's talk about some huge news from United Wholesale Mortgage. They just announced that they're removing all loan level pricing adjustments on FHA loans, VA loans, and USDA loans for borrowers with a FICO score of 600 or higher. This is all effective all the way through March 31st of next year, 2025. If you're not familiar with what LLPAs are, those loan level pricing adjustments, they're essentially what makes interest rates higher for borrowers with lower credit scores, lower down payments, etc. The riskier the borrower, the more expensive the rate, the higher the rate. That's due to these LLPAs. By removing these, UWM says it could improve pricing by up to 150 basis points for borrowers who would normally be hit hardest by those adjustments. Well, what's the goal here? It's twofold. Help borrowers by making it easier to buy a home, increase their buying power, or lower their interest rate. And it supports us brokers by giving them a competitive edge in the market. This is a big deal because UWM often sets the tone for the entire broker channel. When they lead the way with initiatives like this, and it's not the first time they've done something like this, it's only a matter of time before other lenders follow suit. So kudos to UWM for taking this step. It's going to be a game changer for a lot of borrowers. Now, let's look at this week's job market data. Jobs are the focus of this week, with a ton of key data that could shape the Fed's December 18th meeting coming here in a couple weeks, and of course have a big impact on the mortgage-backed securities and the 10-year Treasury. Here's what's coming. Tomorrow, the JOLTS report on job openings. Last month, job openings dropped from 8.2 million to 7.4 million, and this month, it's expected to stay around 7.4 to 7.5 million. Hiring is slowing, and once people lose jobs, it's taking longer to find new ones, and that's what this report will show us tomorrow. On Wednesday, the ADP report on private payrolls. Last month, it showed 233,000 new jobs, but this month, it's expected to slow down to about 150,000. Still strong, but potentially influenced by seasonal factors. And then on Friday, we've got the big one, the BLS Jobs Report. The market expects 195,000 new jobs after October's week 12,000. Largely blamed on strikes and hurricanes. The unemployment rate is projected to tick up slightly from 4.1 to 4.2%, and we'll also be watching the wage data, which could show lower inflationary pressure. So a lot of information coming through on Friday. Keep a lookout for that. Now, why do seasonal adjustments matter? Let's talk about those adjustments for a second. They've been unusually generous this year, and that could lead to some revisions as the year wraps up. Here's a fun fact. Last month, about 220,000 people were dropped from the labor force just because they didn't submit a job application or attend an interview. If these people were included, the unemployment rate would be closer to 4.4% instead of 4.1%. This highlights how survey questions can skew the data. For example, if someone is actively searching online but hasn't formally applied for a job, they aren't counted as unemployed or part of the labor force. That's a big deal because these numbers drive the unemployment rate and the market reactions. Well, let's talk a little bit about the 10-year Treasury. Right now, the 10-year Treasury is hovering right near 4.23% while I'm recording this, which is just above the 200-day moving average. We did dip below it briefly on Friday, but we have been kind of battling it a little bit above it now. Whether it stays there or heads underneath depends on what comes out this week. For mortgage-backed securities, we're up a little bit on the day, even though, we started off about 20, 30 basis points worse. If bonds hold steady near that 200-day moving average, we could see momentum shift in our favor later this week. For now, we're going to keep our eyes closely monitoring that market. And if you've got loans in process, maybe consider holding off on locking for just a little more. But of course, consult your mortgage loan officer for guidance on your specific situation. So, to recap, UWM moves to eliminate those loan level pricing adjustments. It's huge for borrowers and brokers. Let's keep an eye out for how the rest of the market responds. It's a huge week for jobs data with JOLTS, ADP, and the BLS report all coming up. The 10-year Treasury is testing its 200-day moving average, and a break below could mean lower mortgage rates. Thank you. Remember, I'll be back with market updates every Monday, and if there is something that breaks, I'll drop another video throughout the week. Thanks for tuning in. If you have questions or if you want to chat about how this might impact your mortgage or refinance, please feel free to reach out. Catch you next time.